I didn't realize, but there is a lot of skepticism around the book Rich Dad, Poor Dad by Kiyosaki. And so in this video, we'll talk through 3 very simple ideas. Whether you're a skeptic or a cynic, his books are filled with good, solid financial tips, I'm not gonna lie. And here we'll focus on some simple ones. There's no get rich quick nonsense, which is good, as anyone that does promise that is talking out their rear end. Financial acumen and intelligence is what makes money. If you aren't savvy with money, then you will struggle with it. And if one doesn't make it through with dumb luck, like say winning the lottery, it won't stay. And that's why there is a lottery winner's curse, with a great many losing their newfound fortune. And it's not just lotto winners, actually. There are sports stars, athletes, film stars and musicians who also can make more in a month than many of us would do in an entire year, and still have nothing to show for it by the end of it. And it's not difficult to work out either. It's the simplest of financial maths. They spend what they earn, often in excess, and have left nothing invested in times of high income. And once the income stops, they fail to adapt and use up reserves rather fast. And it's that lack of perspective that falls into 2 things. The first one, lack of financial awareness, and the second, lack of using opportunities to use money to build further income from money. So let's focus on the first point, and this is critical for people with above average incomes. Higher income comes with higher risk. It's a simple economic supply and demand. Where you have a particular skill, let's call it a talent, you are able to caress, for example, football, act with conviction, or in simpler everyday life, a great surgeon, qualified lawyer, deal-making banker, or adept salesperson. In all of these examples, your talent is a scarcity. It's scarce, and so it comes with a higher risk. Careers in sports, films and television can end quite abruptly, be it injury, scandal, a few bad movies, so on and so forth. Likewise, a professional career with high levels of stress can have burnout, stress, depression, or the industry evolving, so skills are no longer relevant. We can all relate to one thing or another there. The higher the income, the higher the risk, and so we must critically look at our finances, challenge that status quo, as crisis is something that can hit us all. Even where the top earning career doesn't end abruptly, you can still spend everything you earn. And so when the career naturally ends, there's nothing really left to show for it. And that's pretty deep. Or when we do pay attention for future earnings and make long-term investments, it's an afterthought. Consumption comes first, which means not enough is being deployed towards the future. Bring to the party Robert KIYOSAKI then, who advocates both financial planning and lifelong learning as the best way to keep our financial intelligence up to date. We need to keep educating ourselves on new investment opportunities. So here it goes, 2 basic gems from the Kiyosaki book, but also well documented in other classics of financial literacy. The first one is pay yourself first. This is basically a form of goal setting, which is a proven way to execute. The clue is in the name. A goal helps check where we currently stand and also how much we need to get there. So from a financial planning perspective, it's a fundamental. And like I have said before, treat your personal finances like your own business. Set goals for how much money you want to spend, save and also invest. Budget, guys. Once you start doing that, you will also start being able to plan what you expect your investments to generate for you to lead financially free lives. So Robert Kiyosaki in his book rather blatantly, provocatively talks about paying yourself first. And paying yourself first is an odd turn of phrase because it's actually quite a bit of an oxymoron when you think about it. It's about paying yourself with your money so you can put it to use to achieve your ambitions that you want to achieve with your money, if that makes sense. And fundamentally, paying yourself first is about saving your money, choosing an investment or investing it in yourself to increase your human capital potential. And that's deep stuff right there. So paying yourself first isn't really about getting those Jimmy shoes. That's just paying Jimmy Choo or whoever owns the brand now. Another book, by the way, is The Richest Man in Babylon, that talks about taking a 10% chunk each month as soon as you receive your paycheck and then saving or investing it. And that's a good concept and a good motto to develop into your personal finances now as a starting point. And it's a nice rule of thumb to get started with as well. And once we do that, it means that starting with 10%, we will still quickly realize a few things. Consistency over a period of time accumulates into a lot, and how investing works, and how 10% is just enough. And that should make us feel a little bit more encouraged to do more and respect ourselves and the money that we make for our toil. And that brings me to the second important learning and really the theme of the book, and that is we underestimate how money can work for us. When we strive for financial freedom, we try to search for that holy grail, the passive income dream. I really hate this term actually. Passive income implies that no work is necessary, but that isn't the case. It is work, but the work is done up front to create those income streams that will grow as time goes on, and they are less connected to your time, making us freer. Money once earned can really be made to do work by turning them into little soldiers called capital and investing it. You can do this by investing in real estate, stocks, and lending, some requiring lots of money to be invested, others less so, some being able to be leveraged, others less so. And it sounds difficult, sounds stressful, sounds like work, and of course it is. We always see that end result with those who have done it effectively, and being human, we view it with emotion of fondness and admiration, or envy and jealousy, depending on how we are built as humans. We know that behind every individual that has been successful in building those passive income streams, there are four main things that will always stand out, and those are leverage, using our money and bundling it with other people's money to invest and leverage returns. The second being human capital, and that is the personal blood, sweat, stress, agony, and simply pretty much the time an individual puts into establish that income stream. Third is compounding, keeping investment returns, investing and allowing earned money to work for you. The fourth being partial financial freedom. So financial freedom is not retiring, but living life on your terms and doing the projects and work that you actually want to do. Humans aren't really built to live life on the beach 24/7, guys, even if we imagine that to be bliss. Robert's book pretty much describes how he used capital and leverage to get started with properties, an investment asset which is close to my heart as I do invest in properties myself. And by Jove, guys, it is not passive. On Christmas Day alone, I was dealing with a broken boiler situation for one of the rentals, which just had to be fixed. And my tenant's stress is my stress, so no hot water or no heating when it's 3 degrees Celsius outside. That is just stress, right? That being said, I do love property investment and I love the challenges that come with it. Robert actually points out something very interesting and obvious when you think about it. Most people think real estate investing with debt is high risk because you're borrowing money to buy an asset. However, you have to realize that the debt is always matched by the new property, and instead we need to actually be financially literate and business savvy. Make sure we buy a property that we can rent out, whether it's looking at the location, what the rentals are, understand the costs and time involved, and the debt aspect of it, which is offset by the property price. What about the interest then, is the big question. Well, even if you pay interest on the debt, that's a financing cost, which the real estate returns and some in rent. Also, buying in a city that is constantly evolving, for example, London, and holding your property for a few decades means ideally the property will generate a net capital return and the money borrowed will erode with inflation. I have a video on that too because I'm good like that, guys. I'll link it at the end. Now, I do live in London and I get it. It's hard to think about financial freedom when the struggle to earn, stay employed, pay rent and have fun mean that investing large chunks of money is difficult to fathom. However, we underestimate our human capital, which as a youngster we have a ton of, greatly illustrated by Thomas Frank, one of my favorite YouTubers, a few weeks ago. With time and energy, we can hustle and make things happen more, so that when we are older and have children and are running around and have no concept of time, it's a balancing act. Fundamentally, Kiyosaki is about creating income from assets, which as time goes on can take on our fixed costs of living. Get educated and learn investing. Here are a few videos of why we shouldn't leave money in the bank and call that investing. So check it out and I'll see you